Hello and welcome to the Monday Futures Market Outlook for July 16th, 2013. This is Patrick Ceresna. As always, we start off with just a quick chart of the euro. Again, the euro came to the edge of the cliff down to that 128 focal point, and on the FOMC minutes, the market took a turn for the worse on the US dollar front, and subsequently the euro was able to muster up quite a bit of a rally, almost immediately squeezing almost 400 pips within a 24-hour window. We now can see the euro go back and retest the 132, 133 zone, or even the high 134 right up along here. One of those levels could possibly act as an overhead resistance. We don't see necessarily anything bullish about the euro other than that it's not immediately bearish. Next year, I want to take a look at gold, and gold has now finally put in a short-term bottom at the 1200. That doesn't mean it's the end of the gold bear market, nor does it mean that it's a compelling buying opportunity, but with a short-term low, we are going to likely see a return back up towards this 1350 zone along the upside. What will be the big tell for us will be after we see this retracement higher, there will likely be another wave of selling this summer, and if that does not make a lower low along the 1200 and we rather see good bottoming formations and the price action start to develop, we could finally see the lows from which gold can muster up a substantial retracement. But it's premature for us to make any such assumptions, as the downtrend is very dominant and there's no technical evidence that an uptrend has begun. Next year, I want to look at crude oil, and crude has very bullishly broken out, largely based upon the Middle Eastern concerns, and we've seen now a breakout. Once it broke above that 98-100 zone, it really gained huge momentum and now has exceeded even the year highs. There is some overhead resistance coming up in the next few dollars higher that should initially stall things out, but at this moment the uptrend is dominant. We don't see a scenario where oil really is going to have a huge upside from here, but at least for now it allows many of these oil stocks and other things like that to be bullish, at least on the short term. Nonetheless, we think that there is still a few more dollars on the upside, and so watch for 108 to 110 as potential upside targets. Next year, I want to take a look at the 10-year Treasury bond, and we have seen a short-term swing low down along here as the bond market has calmed down from its concerns about tapering. Really, at this stage, we're now looking at a bit of a retracement. The retracement on the 10-year bond can work its way easily up into this 127, 128 handle right up in here. And we do not believe at this moment that the bond will beat these previous lows. We would need to see price action really become healthy and start to develop, and subsequently have maybe a new input catalyst that would attract money back in the bonds for that scenario to occur. So we are looking for a rally, but we do expect it to fail at overhead resistance somewhere probably in the 128 area. Finally, I want to take a look at the S&P 500, and yet again we've had a very compelling rally in the S&P. We had our 1550, 1560 focal point, which is focused along the top end consolidation, but in fact we today are trading near the 1680 area, which is actually where the print high on an intraday basis occurred back at the highs in May. Really, at this stage, we do believe that the market is going to make a very important decision right along this 1680 level. Either A, it's going to reject there as a double top on the any candlestick or bar chart pattern, or we're going to break out. If we break out with 1700 and even 1750 on the upside, our upside measured move targets that the market can actually advance to. We are not immediately anticipating that breakout to occur, as the market is quite overbought on the short term and could very naturally pull back. But so long as the bulls contain any waves of selling to those kind of 2-3 day little consolidations that maybe hold any selling to 20, 30, 40 S&P points, then the bulls can still remain in control. We would need to see at this moment something change in the conditions of the market that simply point to the fact that the market is poised to correct, and there is no evidence of that at this moment. So at this stage, we're watching for overhead resistance to potentially create a little correction here, but the bulls are still dominant. That was your Monday Futures Market Outlook. Thank you for joining me.